Over the last 72 hours, silver moved from roughly 62 up towards 69. That $7 move in such a short period is exactly the kind of rebound that causes hesitation for anyone who missed the low. When price drops from around 97 down to 62, that's a decline of about 35 or roughly 36%. And when it turns upward even slightly, people begin to question whether the opportunity is already gone. But this is where most people make a critical mistake. They react to the move instead of understanding the structure behind it. In this video, I will show you how this rebound is forming after the drop. Then, I will break down how price is behaving around key levels right now. And stick with me until the end, because I am going to explain to you how to approach your next move without chasing. I need to pause for a brief moment. If you're benefiting from this information and want to stay ahead of this before everyone else catches on, hit subscribe. I expose signals in silver before they go mainstream. What matters most right now is how silver is reacting after touching $62. That level acted as a temporary floor, where price stopped falling and began to stabilize. But the move from $62 to $69 is not confirmation of a full recovery. It is a bounce within a larger downward trend. When a market falls as sharply as silver did from $97 to $62, it often rebounds in stages. The first bounce typically retraces a portion of the drop, often around 20% to 30% of the total decline, which in this case would place a natural rebound zone between roughly $69 and $73. That means the current price sitting near $69 is not random. It is sitting right at the lower boundary of a typical reaction range. Keep this top of mind, because most people are missing this point. The speed of the bounce matters just as much as the size. A $7 move sounds significant, but when it happens after a $35 drop, it is still relatively small in context. More importantly, the bounce has been uneven. Price pushed quickly off $62, but as it approached $68 to $69, the upward movement began to slow. That tells you buyers are not stepping in with the same confidence at higher levels. Instead, each push upward is being met with selling pressure sooner than the last. Now, look at how price behaved around 70. That level previously acted as support, meaning it was an area where price held up before breaking lower. Once silver dropped below 70 and moved into the low 60s, that same level often turns into resistance. In simple terms, what used to hold price up can now act like a ceiling. If silver struggles to move cleanly above 70 and hold there, it suggests that the broader pressure is still in place. Missing $62 does not mean the opportunity is gone, but it also does not mean you should rush in at $69. When a market is still adjusting after a 36% drop, it often revisits lower levels, or at least tests them. That could mean a move back towards $65, or even a retest of $62, if conditions remain the same. On the other hand, if silver breaks above 70 and holds, then the next range to watch becomes 72 to 75, which would represent a deeper recovery. This is where decision-making becomes critical. If you are buying based on fear of missing out, you are reacting to the last $7 move. But if you are looking at the full picture, the $35 decline, the current position near resistance, and the broader economic pressure, you start to see that patience may offer better opportunities. The key is not to predict the exact bottom, but to understand where you are within the move. Silver at $69 is not the same as silver at $62, and the difference is not just $7. It's timing, structure, and positioning. The next move will likely depend on whether price can break and hold above $70, or if it rolls over and tests lower levels again. Either way, the decision you make now should be based on where the market is likely to go